Are people leaving Canada and where is our interest rate going? Hi, Ryan here. So today I wanted to share with you a few articles and recent news on macroeconomics to understand what's going on, because we understand that the real estate market is very heavily dependent on the general economics and the well-being of Canadian economy, and interest rates and rent prices, immigration, unemployment rates we talked about last video, they all matter to real estate market, right? So let's take a look at what's going on in the world. So first of all, on the screen, you'll see that this is the current benchmark rate for both Canada and the US. Canada is this bottom gray line, and the blue line on the top is the US. And you can see that just from a glance, you'll see the difference between these two are diverging, right? They're becoming bigger. There's a bigger difference between the US and Canada's benchmark rate. And that started in the beginning of 25, right? Last year, around mid 2024, both countries started to drop rates. Canada started first, US started later, but they both dropped, right? And Canada had a few more jumbo cuts in September, October, and that's why we had a busier, better real estate market last year in October, November, right? Because of these jumbo rate cuts at 0.5% each. So you can see that rate cuts, they help, right? And from general finance principles, we understand rate cuts will generally help real estate. However, because of other macroeconomic factors and also tariff and these black swan events, it is also hindered or canceled out the effect from the lower rates, so that we're at a stale now, right? That's why the real estate market is really bad right now, because of these other factors. But on its own, dropping rates is good for real estate. And for the US side, you can see it's a different economy, right? Their interest rate had remained flat. So right now we're at, US is at 4.5, Canada is at 2.75. There is this difference of almost 2% is the biggest ever in the recent history, and between the US and Canada. And so we're at the biggest difference in our economies as well, right? So which we can generally see. So that's just kind of just to give you a snapshot of what's going on in the interest rate. But the interesting part is for the remainder half of the year, you know how each country have about 8 times where they make interest rate decisions, and generally they're on different dates, right? For example, the US this year, they had, let's say, January 29th, March 19th, and we had March 12th, April 16th. America didn't have a rate decision in April, right? So it's different. And US had a May 7th, and we didn't have a one in May. We had a June 4th, and the US just had June 18th, which neither country moved, right? So we can see that there is generally some differences. But going forward for the remainder of this year, July, September, October, December, that's the next 4 rate decision dates. We can see they're actually aligned exactly, right? US, Canada, they're both at July 30th. Is coming up, which we know it's likely not going to drop rates, which we'll see. September 17th, and that's what we're counting on, right? A lot of people are counting on September 17th rate drop to be a major one, right? Or at least start moving again. And then October 29th and December 10th, they're both aligned exactly on the same day. So I don't know if that's a coincidence or they did it on purpose just to, be in sync, or they cannot really copy each other. Everybody has to make up their own mind on the same date. So it'll be interesting to watch, right? And for us, these will be very important dates to watch. And if we're taking a look at what's driving the change in rates, it's mainly the inflation expectation. We can see that in Canada, let's take a look at the general inflation. Okay, so Canada general inflation is year over year at 1.7%, right? As you can see on the screen. The latest number, 1.7%, is the same as April, 1.7%, and it's lower than most of the previous month, right? Which is good. I mean, on a glance, that looks good, because our goal is to keep inflation below 2%. So why do the news all say that, hey, we're not gonna see a rate cut soon because these inflation numbers it's okay, but it's not great? Why is 1.7% not great, right? That's the question, because on its own, it looks pretty great to me. So if we take a look at the consumer price behind it, this is the actual price of our goods, right? Not like a year-over-year percentage, because inflation rate is a year-over-year percentage. But the actual underlying price is what you see on the screen. And we can see that ever since 25, last year, the general price was very stagnant, right? You can see it's very generally not going up. But this year, 25, ever since February, the price it's shooting up again, right? There's a lot of factors to it, tariffs and other factors, but it is going up, right? So even though you see only 1.7% on a year-over-year basis, that means this number divided by this number is 1.7%. This is not a concerning trend, right? So that's number one. And number two is core inflation. You can see that core consumer prices, which get rid of, the gas and mortgage interest, like these fluctuating ones, just the core goods that represents everybody's daily needs, is going up consistently as well. And Bank of Canada don't like that, right? In fact, if you see Stats Canada's website, which gives you a better indication, you can see that the measure of core inflation, there's three measures. There's core CPI common, there's CPI median, and then there's CPI trim. Okay, there's three different core inflation measures. Doesn't matter, the exact definition, but we can see they're all pretty high. 3%, 3%, 2.6%, right? And they're generally from the past 5 months, you can see it's an upwards trend from 2.5 to 3, 2.8 to 3, right? It's upward trend. So that's not good. And that's why the Bank of Canada say, hey, you know what? We want to take a look at it in a more slower pace, right? We want to observe how the inflation progress, because if the core inflation keeps going up and the actual underlying prices keeps going up, then we may have to wait longer for another rate cut. And if it goes up too quickly, then we even need to consider rate hikes, right, to control the inflation. Remember, Bank of Canada's single mandate is to control inflation. So that's the risk we're facing here, right? And in regarding to the actual consumer price index, is it all bad news? I mean, there's some good news, right? You can take a look. So this is basically where the 1.7% breaks down. The 1.7% breaks down to food. You can see food, shelters, household operations, furnishings, clothing, transportation, healthcare, recreation, and alcohol, right? Just these are general categories. And you can see that food and shelter are still the majority and the bigger categories that's going up. And what's driving down the inflation is transportation, which, removal of carbon tax, lower gas prices, that all helps with. And then other factors are around the 1.7 mark, which is not contributing or not helping, right? So you can see that it's gas, transportation that's offsetting the gain in food and shelter, but this is already a lot better than before. The food and shelters is nowhere near how it was like back then, because if you look at, like, say, for example, mortgage rates, price for rent and the mortgage interest cost, okay? These are a big part of, I guess, rent and the mortgage interest cost continue to grow at a slower pace. That's good. So you can see that on this graph, the top part is mortgage interest rate, right? As you can see, ever since we started to control the hike of interest, which stopped sort of in 2023, right? And 24, we started dropping rates. So you can see that between the mid 23 and 24, the actual spending on mortgage interest is indeed dropping. So it helps. It's making people's life a little bit easier, right? In terms of they're not paying more and more and more on mortgage interest. And as you can see, rent prices, ever since the beginning of last year, it's kind of on a declining trend. A lighter blue bar you see at the bottom, right? You can see that it's on a declining trend from the past, I would say, 12 to like 16 months. We reached the peak at around mid 24. Like summer last year, we reached a peak in rent. And then the rent started dropping the past 12 to 14, 16 months, right? So why is rent dropping, right? So that's another question. But first of all, let's take a quick look at the expectation for rate cuts, right? Because we're talking about like all these inflation, how it impacts rate cuts decisions. So what is the financial market saying about rate cuts? So right now for July 30th, right? We're looking at the US. The US side, about 77% chance we're staying put, okay, in July. So no rate cuts, only 22% chance we may see a rate cut. But for September, you'll see a very different result. 72% chance we're going to see a rate cut for the US. And 20% chance we'll see a jumbo rate cut, 50 basis point, right? And only 8% chance that's not going to cut rates. So that's interesting, right? So between July and September, there's a big difference on where the rate is going expectation. So that's something that we should be looking out for. So why is rent going down? Like we saw in the previous slide, Okay, so that is an interesting question, and we're going to talk about that in the next video. Due to time limitation, I'm trying to keep these videos shorter, right, based on your feedback. So stay tuned, subscribe, and until next time.